everybody to our webinar today. And my name is Alan Kitterman. I'm the commercial real estate leader with Black Diamond. And we call the division commercial real estate now, but our firm name is Black Diamond Capital Advisory Firm. And this is, to my far left, is Maurice LaFears. He is our commercial real estate agent. And then in the middle here is Chase Piotrowski, who is going to be our moderator today. Chase is our associate, and literally he has his hands in everything. So he is our resident expert who goes by the name of associate. So we really do appreciate all the work that he's doing. So I'm going to hand over to Chase to begin our actual discussion about the cap rates, and we'll get going.
Awesome. Thank you, Alan. Today we're kind of going to cover the great cap rate debate. And Alan, if you want to go ahead and start and just kind of explain to us a little bit more about what cap rate is and maybe some intended uses of what it might be.
Okay. The cap rate is just short, is in commercial real estate, is a shorthand that basically tells you how much a buyer is going to pay for $1 of income on the first year basis. It's very similar to the price earning ratio in the stock market, but it is, the simple formula is net operating income divided by whatever you paid for the property on an income producing property. And it can be useful in comparing like buildings and like markets. And, it's one of those things that's a very specific tool be used correctly. And you don't want to go out and start comparing things willy-nilly. A office building in New York City compared to one in St. Louis, compared to one into a factory in Northwest Arkansas, that's not its purpose. But what it can do on a general basis is you can look at trends in markets and trends overall and use it as a subtle tool. The way I look at it is kind of like a butter knife. I can find a lot of uses for a butter knife, but it's not necessarily the intended purpose. It still gets the job done.
Absolutely. Maurice, you have anything to add to those intended uses?
No, I think Alan covered it pretty good.
Too. Awesome. So looking at the cap rate and knowing it's such a specific tool, kind of why are we here and what are we looking at it specifically with the cap rate?
I'll jump into that. So as Alan mentioned, every particular market has its comparison. So the purpose of the cap rate is comparison to like investments in the same market. So within the area that we're in, Northwest Arkansas, your cap rates would be based on those like investment opportunities. The difference between markets intended for the different uses of properties. If someone wants to use the investments analysis, the ROI calculator is what we usually use. That ROI calculator takes those like investments and show you what the value is for your local market. So you want to make sure that when you are looking at cap rates, you are doing like investments in a similar market, because that does differentiate between the areas or the markets in which you reside or support.
And then on a macro basis, what you can do is whenever someone is investing, basically they are trading the use of their money for the rent of their money, but they are taking into account how much risk there is in the investment. And the cap rate is a very general basis of looking at how much the market is paying for that risk and how much is anticipated. Now, the cap rate is not going to be as volatile as the interest rates or the mortgage rates, but it does show really good trend. And, as an investor, you will have a thesis that you're operating off of, and you know kind of how much risk you're willing to take and what it's going to take you to put your money into that project. On the cap rate, you look at and think about what is the thing about the cap rate, and this is really hard, is because most of the time what we see is what the seller is anticipating, the payment that they think that they should have to pay for the risk that they anticipate that the buyer or investor is seeing in the marketplace. And to actually see what the actual cap rate is and what it is on the buyer side, becomes a little bit more difficult by looking at the transaction basis. But, but one thing that you can see is what the buyers are anticipating it takes to get someone to invest in their property.
Awesome. Now that we kind of know more of what cap rate is, what are some other fundamentals to consider outside of just cap rate that might affect it? Maybe some U.S. Treasury notes and things like that.
I'll jump in.
Okay.
The biggest thing that you want to look into outside of just cap rate would be what is my risk-free interest rates? Kind of diving into it's important to take into account that. So what is risk-free? In general, for a 10-year U.S. Treasury bond, there's usually a 4+% rate that's there. Always considered an option for investors. If you want something that's kind of, I can sleep at night. I know what my rate's gonna be. I know what my risk is. It's kind of, it aligns with my plan. We want to make sure that that's something we look into. Also, the current 2-year Treasury yield is 5+%. So based on looking at that, what my yield is going to be based on my risk tolerance.
Right. And as the Fed has moved the interest rates up, it's become more and more of an attractive option for people to just put their money to rest and earn interest on it. And you hear mention out there that the commercial real estate market has gotten tougher and all that because of the higher interest rates. And what it does to the cap rate is it reduces the value of the income producing property because there has to be a bigger gap between what's being paid and what's being returned. And looking at that versus the 2-year, in particular, 2 years to put your money to the side and earn interest rates is not that bad of an option for a lot of things. So that is putting pressure on the people who are selling property to keep the value of it down so it becomes more attractive to someone if they want to move it. And there's a lot of people who are deciding, hey, this may not be the market for me. I may not be willing to give that value up, and I may wait to see if something is going to get better down the road. So, we're seeing that in the marketplace a little bit. But right now, before we even get to what our observations are about the marketplace, we wanted to make sure that you understood what the tool that we're using, its limitations, and realize that we're reading a lot into it, to be quite honest. But it is a useful tool. That's something that you have to keep in perspective. A lot of times when an investor comes and talks, the first question is, what's the cap rate? Well, we can tell them, but we want to make sure that the people that we're dealing with understand all the implications that we can tell them about.
Benefit of why a lot of investors look at this area is because they feel that their principal is more protected in that space. So that's going to have less volatility than what your cap rate would have. So that comfort level of saying, hey, my principal is protected is to some degree. There's always some risk in investing. It's why we have several investors looking at that area as well.
Now, you mentioned kind of some observations that we might get into about the current marketplace. Just kind of dealing day to day, looking at what's out there. Can you kind of express your thoughts on the current marketplace and where it's headed?
Okay, there's 2 things that's happening. Number one, you're seeing people who are dealing with their broker and they're getting an honest assessment and accepting that honest assessment of what it's going to take to get someone to invest in their property. And those cap rates are drifting higher. And in some cases, they're jumping higher. But there is a general drift higher about what someone is willing to accept in order to move the property. You can't ignore what's happening on a macro basis with the Fed. And they have a 5% rate, the most in history, rate increase over the past 18 months has had its effect. And there are sellers and buyer investors both are trying to figure out where we are in the cycle and what the effect is going to be on the prices long term. There's one camp that says, hey, we're at the bottom of the value cycle for property and the Fed can't hold their rates this high and interest rates are going to drop. So if we just wait a little bit to sell our property, then it will increase in value. We can wait this through and it's not going to be that long. You have the other side of it, which is mainly some of your more aggressive investors that say, no, there is a big gap out there. It's going to be a long time. The Fed is saying it's going to keep things higher for longer. And there's going to be a moderate to major reset in the value of property, commercial real estate out there. And really, both sides, there's good arguments to both sides. You know, in my personal opinion, I believe it's the higher for longer. It's going to take some patience. And there's a general tightening of the money supply. So it's time for people to look at it, look in the mirror, take a long, hard look, and make sure that they're not looking at things through rose-colored glasses. You know, it's not time for panic, but it may be time for a little bit of realism to set in.
I'll say most sellers are starting to kind of realize the value of their investment. So they're looking at live listings, and they're looking at cap rates and saying, here's kind of where we're trending, which is currently on an uptrend. It's a little harder for those that have closed to get a true cap value, even though it's transparent. There's a flux. What was it listed versus what did it close for? What was your sale price? So looking at that lit cap rate for those active listings is what investors are really looking towards, say, based on, as we talked about earlier, what is my investment in my market, and what it is listed for, or in some cases what it is sell for.
And then, looking at the market and outside of the market as well, what are some other complicated factors that people have to take into account and be on the look for?
I think that an investor really needs to think about what their risk tolerance is. I know I don't know about you, but every time you open up an investment account, they ask you what your risk tolerance is, and they try and talk to you through it. My thing is, I believe that people should do what allows them to sleep at night. You know, and live with themselves, you know, do what you can do comfortably. Don't put yourself at a tremendous amount of risk. But, there's time. I think that in my own life, there's a certain amount of risk I have to have in my life, or else I'm going to go out and play lottery all the time, because there's just a certain amount of, there's a game to it. You play the game, you get what the risk return is out there, and you don't want to give it up. But you need to probably have more. If I was going to lean anywhere now, don't lean a little bit more to the conservative, but life is going to happen. There's times that people die, they have to move, they have to liquidate property to pay other bills, they have to do things. And so think about it, say, I can live with this. And if you do list your property, or if y'all invest in property, think about, what can I live with in these? And realize there's going to have to be there's more volatility. There's more going toward the tail end of events right now than what there has been in the recent past. And, but it all boils down to, nobody can make you buy or sell a piece of property other than, I guess, a foreclosure, maybe, but we're not talking about that right now. But you have to just look at yourself, look at what you're comfortable with doing with your money, look at the returns that you're comfortable with, and have a thesis in your mind that you can articulate to yourself or to other people that's going to generate how you handle your money and your investment.
And based on that risk tolerance, when you go into that and you're thinking about, what is my risk tolerance? It's good to have that plan on, am I playing the long game or the short game? Are we waiting the market out? So that's where we can come in and help. Alan and I can help you with that evaluation and dive in and say, well, based on what your risk tolerance is, what your investment strategy would be in the general market, guide you through that process. So always understand, is it something that I can wait on, and I know and I understand what my market looks like. I'm educated enough to know that down the line, there's a potential. There's never a guarantee, but there's a potential that here's where I would end up, or I need to get in and get out. Whatever your strategy is, think about what that is, tie that to your risk tolerance, and then can help you do the rest.
Yeah. And that's how we kind of look at our job. We're not here to try and force someone into investment or force someone into selling their property, but we want to talk to you. And even if you're on the fence about what you're going to do, it's good to have another person to talk to and evaluate and get another set of ideas. And on the commercial real estate side, a lot of times it's a pretty long-term investment, and there's a lot of you're making a commitment to do something, and it's going to take some patience, and we can talk you through that. And we can talk about, say, realistic expectations, and kind of not necessarily be a psychiatrist, but at least be a good friend about it. So, but right now, we're welcome to any questions and answers that we have. That the bottom line that we want you to do is understand the cap rate, what it's showing you, and how you can use it as a tool, and also let you know that we're here to help. If you have a question, please put it in the chat box,
No, they can.
or you can unmute yourself and ask it.
That'd be one question out there.
Well, let me ask you. I'll ask you a question. You're out there every day looking at it.
Mhm.
What are you hearing from people on a first-hand basis?
So several different things. So from a seller's perspective, because the market has been so high through the pandemic, and those prices have just things that as soon as you put it on the market, it's been selling. The sellers are still in that mindset. They haven't quite shifted to where the market is at. Rates, buyers are now taking control and saying, hey, this is what we have as a risk tolerance and what we're willing to pay. That's actually getting us a good pool, because now we have more buyers coming in and saying, hey, we're willing to be creative based on this data. So we're able to help support both the seller and the buyer work through some of those transitional periods as the rates go up and inventory kind of goes down, so that both parties can walk away with a win-win.
Don't see any more questions. Do you see anything? Okay. Well, we would appreciate your time, either if you're live right now or if you're listening to us later on YouTube and other channels. But once again, thank you, and we would look forward to talking to you again at the next webinar next month.
Thank you.